So, Jim, you went to Treasury, and you, as a workout guy, tried to sort out a really hard one, AIG, the largest bailout in history. Tell us what you faced when you went in.
Well, you had a company that was facing an enormous liquidity crisis, and the Fed and the Treasury Department, through the TARP program and the various extraordinary loans that the Fed made, stabilized its liquidity, but it ultimately needed a significant restructuring. Risk management really had failed at AIG. As Steve said about the car companies, part of this was a corporate governance crisis. This was a company that was just too big to manage. And so it was one, as with the auto companies, AIG was really one of the few financial institutions during the crisis that we actually did a comprehensive restructuring of. By the time we were done, the taxpayers were fully repaid for the entire investment, but the company was about half the size that it was coming into the crisis.
Right. We just showed the numbers, actually. They actually returned about $23 billion net to the U.S. Treasury. But a similar question to Steve, because that industry is a different industry. Was that simply a failure of corporate governance, or was there a failure of regulatory oversight as well? Because that's a much more regulated business than the car industry is.
Yeah, no, I think this is one of the key lessons that we learned in the crisis, that the financial system had grown outside the regulated sphere. AIG had a subsidiary called AIG Financial Products, which had $2.5 trillion of various derivatives that it was a counterparty to. And effectively, no one was supervising that. So, one of the innovations of Dodd-Frank, of the financial reform implemented under Dodd-Frank, was to try to bring within the regulatory ambit these parts of the financial system that had really grown up outside of it. Now, that having been said, I think Dodd-Frank only got us halfway there. Today, banks constitute about a third of credit intermediation, and we have a very bank-centric regulatory structure. 2/3 of the credit that's being created in the United States economy is happening outside of the banking system.
Right.
And this is something that we have yet to address really in a comprehensive fashion at the federal level.
So we'll talk about what comes next and where the next crisis might come from in a second. But I guess my question for both you and Steve is, did we learn a lesson when it comes to corporate governance? Do you think it could happen again in that sense? Not in the sense of a huge downturn. There was a huge downturn that really triggered both of these. But it's that old parable Warren Buffett talks about: when the tide goes out, you see who's wearing bathing suits or not. We found out AIG was not wearing a bathing suit. Are there companies out there today that don't have the systems in place to really protect themselves?
I think we'll only find when the tide goes out who is failing to protect themselves. I mean, risk management practices in the financial industry have improved. Nothing like a good crisis to scare management and boards into improving their systems.